What advice would Warren Buffett give his younger self about investing? Let's start from the beginning of his career. Picture a young Warren Buffett, fresh out of college, just dipping his toes into the vast ocean of the investment world. The year was 1956, and Buffett was eager, ambitious, and ready to make his mark. His early investment career was marked by a series of hits and misses, successes and failures. Buffett's initial investments were not in glamorous high-profile companies, but in solid, dependable businesses that he understood. Companies like Geico, a car insurance firm, and Sanborn Map Company, a map maker and insurance company. These investments may have seemed mundane, but they were the stepping stones to Buffett's future success. These early investments taught Buffett valuable lessons. He learned the importance of investing in what he understood. This principle would become a cornerstone of his investment philosophy. If he didn't understand a business, he didn't invest in it, no matter how enticing the prospects might seem. Buffett also learned the importance of starting early. He was just 25 when he started his first investment partnership, Buffett Associates Limited. This early start gave him the advantage of time, allowing his investments to grow and compound, leading to greater wealth in the long run. But it wasn't all smooth sailing. Buffett had his fair share of failures too. His investment in a textile company called Berkshire Hathaway, for example, was initially a failure. But instead of giving up, Buffett learned from his mistakes and turned Berkshire Hathaway into a powerhouse holding company. In these early years, Buffett learned the key principles that would guide his investment strategy for the rest of his career. He learned the importance of understanding the businesses he invested in, of starting early, and of learning from his failures. So, what advice would Warren Buffett give his younger self about investing? He would likely stress the importance of starting early, investing in what you understand, and learning from your mistakes. As a young man, Buffett learned the importance of investing early and sticking to what he knew best. Buffett's next advice to his younger self would be about the art of value investing. Now, value investing sounds like a complex term, but it's actually quite simple. It's the practice of buying shares in companies that are undervalued by the market. This is where Buffett's timeless advice comes in. Price is what you pay, value is what you get. The Oracle of Omaha, as Buffett is often called, didn't become one of the world's wealthiest men by chasing hot stocks or investing in companies with overinflated values. No, Buffett sought out companies that were selling for less than their intrinsic value. He looked for businesses with strong balance sheets, robust earnings, and a competitive advantage in their industry. But here's the key. He wasn't just interested in their current performance, he was looking for indicators that suggested they would continue to perform well into the future. This is the essence of value investing. It's not about buying low and selling high. It's about investing in companies that have the potential for long-term growth and holding on to those investments for years or even decades. This approach to investing requires a lot of patience and a keen understanding of business fundamentals. It's not about jumping on the latest trend or riding the wave of a hot IPO. It's about doing your homework, understanding the company you're investing in, and having the confidence to stick with your investment even when the market fluctuates. Buffett's advice is not just about making money, it's about building wealth. And the difference between those two concepts is significant. Making money can be quick and fleeting. Building wealth is slow and steady. It's about accumulating assets over time, not getting rich quick. So if you're looking to follow in Buffett's footsteps, remember this. Don't just look for companies with a low price tag. Look for companies with a strong foundation and the potential for long-term growth. For Buffett, investing was not about quick profits, but about long-term value. Buffett would undoubtedly remind his younger self about the importance of patience in investing. Imagine for a moment, you're a farmer planting seeds in a field. You don't just plant the seeds and expect to harvest the next day, do you? No, you water them, nurture them, and patiently wait for them to grow. Investing in many ways is like farming. It's about planting financial seeds and giving them time to grow. Warren Buffett, the Oracle of Omaha, is a testament to the power of patience in investing. He didn't become a billionaire overnight. He achieved this feat by patiently sticking to his investment strategy, not being swayed by market fluctuations. When others were panicking, selling off their investments due to a market downturn, Buffett remained calm and patient. He knew that the market is like a pendulum, always swinging back and forth. But why is patience so important in investing? Well, it's because investments need time to mature. It's like baking a cake. You can't just put it in the oven and take it out after a few minutes. It needs time to bake. Patience allows you to ride out the inevitable ups and downs of the market. It ensures you don't make hasty decisions based on short-term market movements. Patience also helps you stick to your investment strategy. Buffett is known for his buy and hold strategy. He buys companies he believes in and holds on to them for the long term. He doesn't get swayed by market noise or panic when things don't go as planned. His patience and belief in his strategy have paid off handsomely. So if you want to be a successful investor, you need to be patient. You need to give your investments time to grow. You need to stick to your strategy and not let market fluctuations sway you. In the investment world, patience is indeed a virtue. Buffett would also tell his younger self about the power of compound interest. Picture this: you plant a single seed and over time this seed grows into a tree. Now this tree doesn't just stand tall and sturdy, but it also starts to bear fruits, each carrying seeds of their own. These seeds fall, take root, and grow into more trees, which bear more fruits, and the cycle continues. This, my friends, is the essence of compound interest. Compound interest is the interest you earn on both your original money and on the interest you continually accumulate. It's interest on interest, growth on growth. You're not just growing your initial investment, but you're also growing the growth. It's a beautiful cycle of continuous multiplication, and this is where the magic happens. In the world of investing, time is your greatest ally. The more time you give your investments, the more they can grow. And Warren Buffett, well, he understood this concept early on. He recognized the power of compound interest and harnessed it to exponentially grow his wealth over time. Imagine if you start with a modest sum, say $1,000, and you invest it at a 7% annual return. After the first year, you're not just earning interest on that $1,000, but also on the $70 that your investment earned. As time goes on, this interest starts to accumulate and your investment begins to grow at an increasing rate. 10 years down the line, your $1,000 would have more than doubled. And in 30 years, well, that's the beauty of compound interest. It has the potential to turn your $1,000 into more than $8,000. This is how Buffett built his empire. He didn't just invest his money, he let it grow, he let it compound. And this is the wisdom he would pass on to his younger self. It's not about the quick wins or the get-rich-quick schemes, it's about understanding the power of time, the power of patience, and the power of compound interest. Never underestimate the power of compound interest. Lastly, Buffett would remind his younger self about the importance of ethical investing. As we dive into this final piece of advice, it's crucial to understand that for Warren Buffett, investing goes beyond just financial gains. It's about contributing to a better world. Buffett's philosophy of investing has always emphasized the importance of ethics. He believes in investing in companies that not only deliver good returns but also uphold strong ethical standards. This is because Buffett understands that the path a company chooses to achieve its profits matters just as much as the profits themselves. When we talk about ethical investing, we're talking about considering the social and environmental impact of our investments. It's about asking ourselves, is the company we're investing in contributing positively to society? Are they respecting the environment and prioritizing sustainable practices? Are they treating their employees fairly? These are crucial questions that Buffett would want his younger self, and indeed all of us, to ponder over before making an investment decision. Why is this so important, you might ask? Well, businesses that prioritize ethics and sustainability are often more resilient and have a better chance of long-term success. They are less likely to face legal or reputational issues that could harm their profitability. Moreover, by choosing to invest in these companies, we contribute to creating a world that values not just economic growth, but also social justice and environmental sustainability. Let's also remember that ethical investing doesn't mean sacrificing returns. On the contrary, numerous studies have shown that ethical investments can perform as well as, if not better than, traditional investments. So, by investing ethically, we're not just doing good for the world, we're also doing good for our wallets. For Buffett, investing was not just about making money, but also about making a positive impact on the world. As we conclude this scene, let's take a moment to reflect on this powerful message. It's a reminder that investing isn't just a financial journey, it's also an ethical one. And as we navigate this journey, let's remember to make choices that align not just with our financial goals, but also with our values and principles.